Welcome back to Mastering MHA. In this video, we are diving into Chapter 2, the balance sheet and overview. If the income statement tells you how a company performs, the balance sheet tells you what it owns, what it owes, and what's left over for owners at a single point in time. Think of it like a financial snapshot, a freeze frame of a company's position on one specific date, such as December 31st. What is a balance sheet? The balance sheet, also called the statement of financial position, shows three key elements: assets, liabilities, and stockholders' equity. The classic formula is simple but powerful. So assets equals liabilities and stockholders' equity. Every dollar a business owns has to come from somewhere, either from borrowing liabilities or from owners' investment and retained profits, equity. Structure and format. Most companies report consolidated balance sheets, which include the parent company and its subsidiaries. They are prepared at a point in time and usually shown comparatively, for example, December 31st, 2024 and December 31st, 2023. A classified balance sheet separates assets and liabilities into current and non-current categories. Items are listed in order of liquidity, how quickly they can be turned into cash, while liabilities are listed by how soon they must be paid. Common size balance sheets. Analysts often convert each line item into a percentage of total assets. This creates a common size balance sheet that reveals the structure of assets, how much is in cash versus long-term investments. The capital structure, how much debt versus equity is used. It's a simple but effective tool to compare firms or spot trends over time. Assets. What the firm owns. Assets are divided into current and non-current categories. Current assets. These are expected to be converted into cash within 1 year or one operating cycle. They include: first is cash and cash equivalents, currency, and short-term investments maturing within 3 months. Second is marketable securities, short-term investments classified as held to maturity, trading, or available for sale. Third is accounts receivable, net, money owed by customers, shown net of an allowance for doubtful accounts. Analysts check whether receivables are growing faster than sales, a red flag for aggressive revenue recognition. Fourth is inventories, goods held for sale or production. FIFO, first in, first out ending inventory, reflects current costs. LIFO, last in, first out higher cost of goods sold in inflation, not allowed under IFRS. Average cost, uses weighted average prices. Conservatism, value inventory at the lower of cost or market. Fifth is prepaid expenses, payments for items like rent or insurance that will benefit future periods. So working capital is basically the subtraction of current assets and current liabilities, a critical measure of short-term liquidity. Non-current assets, fixed or long-lived, provide economic benefit for more than 1 year. First is property, plant and equipment, PP&E, recorded at book value equals the subtraction of cost and accumulated depreciation. Straight line depreciation spreads the cost evenly. Accelerated methods record higher expenses early. Land is not depreciated. Second is goodwill, the premium paid when buying another company. Tested annually for impairment. If book value greater than fair value, the excess is written off. Third is other assets, long-term items like patents, trademarks, or property held for sale. Fourth is cryptocurrency. In the US, crypto is treated as an indefinite-lived intangible asset, written down if value falls, but not written up if it rises. Liabilities, what the firm owes. Liabilities represent the company's obligations, claims from creditors. Current liabilities, due within 1 year or one operating cycle. Examples include accounts payable, unpaid supplier bills, short-term debt, bank loans, or commercial paper. Current maturities of long-term debt, upcoming principal payments. Accrued liabilities, expenses incurred but not yet paid, like wages or interest. Unearned revenue, cash collected before delivering goods or services. Non-current liabilities, obligations due beyond 1 year. Common examples: deferred income taxes, timing differences between accounting and tax reporting. Long-term debt bonds, mortgages, debentures, and notes. Leases, ASC 842 and IFRS 16. Finance leases is in substance purchases, record an asset and liability. Operating leases is similar treatment but single lease expense. Pensions and post-retirement benefits, Defined benefit plans create long-term liabilities. Defined contribution plans limit obligation to the contribution itself, commitments and contingencies, future contractual obligations or potential lawsuits often disclosed in notes. Stockholders' equity, the owner's claim. Equity represents the residual after liabilities are subtracted from assets, what the owners truly own. Key components: common stock basic ownership with voting rights. Additional paid-in capital amounts received above par value. Retained earnings. Cumulative profits kept in the business. Let's connect the income statement to the balance sheet through retained earnings. Here's the formula you'll always see. Beginning retained earnings plus net income minus dividends equals ending retained earnings. This equation shows how profits flow through the business from what's earned to what's distributed to what's kept for future growth. This simple equation shows how profits flow into the business and how dividends flow out to shareholders. If the company earns more than it distributes, retained earnings grow, building long-term equity. But remember, retained earnings are not the same as cash. They represent accumulated profits, not money sitting in the bank. A company can have high retained earnings and still be short on cash if those profits are tied up in assets like equipment or inventory. Other equity accounts: preferred stock, fixed dividends, no votes. Accumulated other comprehensive income, unrealized gains, losses. Treasury stock, repurchased shares, shown as a reduction in equity. Now let's connect the dots between all three major financial statements, because none of them stand alone. The income statement tells the story of performance, how much the company earned or lost during the period. Those results flow directly into retained earnings on the balance sheet, linking profits to equity. Next, the balance sheet connects to the statement of cash flows. Changes in assets and liabilities like receivables, inventory, or payables show up as cash inflows or outflows in the cash flow statement. Together, the three statements give a complete picture. The income statement shows performance, the balance sheet shows position, and the cash flow statement shows liquidity. Think of them as three sides of a triangle, each one essential to understanding the full financial story of a company. Analyst focus: quality of reporting. Not all balance sheets are created equal. Analysts look beyond totals to judge quality. Key questions: are assets overstated or impaired? Is working capital positive? Are short-term liabilities funding long-term assets a potential liquidity risk? Is there off-balance sheet financing hidden in the footnotes? Are reserves, allowances, and depreciation methods reasonable? Quality means the balance sheet reflects economic reality, not creative account. The balance sheet in action. Now that we've broken down every part of the balance sheet, let's see it in action. The balance sheet isn't just a list of numbers, it's a tool for evaluating how well a company can survive, grow, and adapt. We use it to measure three things. Liquidity: can the company meet its short-term needs and pay its bills on time? Solvency: can it handle long-term obligations like loans and bonds without running into trouble? And financial flexibility: does the company have the freedom to invest, innovate, or recover if times get tough? Together, these measures reveal not only the firm's stability, but also its strategy. A strong balance sheet means more than strength today, it means resilience for tomorrow. The takeaway: the balance sheet is the foundation of financial analysis. It connects directly to the income statement through retained earnings and to the cash flow statement through asset and liability changes. If you can interpret the balance sheet, you can assess liquidity, solvency, and long-term sustainability. In short, you'll see not just where the company has been, but whether it's built to last.